see the yields on treasuries went down because people flocked to them as safety. But notice this, the more speculative segments of the market, the yields shot up. At the same time, yields on treasuries were going down. The reason for that is investors were panicking about the creditworthiness, and rightly so, of many of the corporate bonds out there, especially, for example, the banking bonds, which we know many banks had to get bailed out during the housing crisis here, and the treasuries went down. Hello, everybody. It's John Lodrum, a partner and co-founder here at New Harbor Financial Group. This video is really educationally based, and this video is the first in a series on broadly what we call income investing. We get a lot of questions about investing for income from our clients and prospective clients, and it's natural because for most folks, they work and save and build up a retirement nest egg really for the purpose of providing a replacement paycheck, so to speak. So it's natural that folks would be drawn to thinking about how can I pursue income type of investments in my retirement strategy. This video is going to cover one type of income vehicle, and specifically bond investing. Many folks might know that bonds are referred to as fixed income. So very much in that kind of label speaks to one main purpose or main benefit of bonds. Please subscribe and like the video. We welcome comments and suggestions for future content. So without further ado, so what are bonds? Can I keep it real simple? The financial industry has quote unquote innovated so many products over the years that it's dizzying for many investors and folks that aren't too familiar with all the ins and outs of financial markets. But I like to boil it down into two simple types of assets: ownership assets and what I call loanership assets. So ownership assets are things like stocks, where you actually own a slice of a company or many companies if you're in a pooled investment vehicle like a mutual fund or an ETF. Loanership assets are bonds. Why do I call them loanership assets? Because when you buy a bond, what you're really doing is lending your money to the issuer of that bond. Many people aren't aware that that's actually what you do when you buy a bond. And who are you lending money to? Well, bonds can be issued by many different entities. Most notably, the U.S. government. Treasury Department issues bonds to the general public, both here and worldwide, to fund operations. And those bonds are issued by the U.S. government. There are also corporate bonds. Many companies issue bonds to help fund their operations. There are municipal or agency bonds. Some municipal governments, local governments, states and cities and towns issue bonds for many things, fund their operations, to pay for capital projects, things like that. That's the first thing you need to know, that when you invest in a bond, you're lending money to an entity. So like any lender, you're going to want to do your due diligence. Is that borrower creditworthy? Are they worthy of repaying your loan? The way that you earn a return in bonds, it's basically two components. Like many loans that you might take out as a consumer, you usually will pay a rate of interest to, for example, the mortgage company, and as well as a periodic payment of principal. When you invest in bonds, the borrower, let's take the U.S. government, for example, they will pay you interest periodically. And if it happens to be that U.S. Treasury bonds pay interest twice annually, so every 6 months. However, some bonds are issued with what we call zero coupon. The return from a bond investor comes from a coupon payment. Why are they called a coupon? Because back in the olden days, you literally had a sheet of paper that was issued to you when you bought a bond, and you tore off a little ticket, basically a coupon that you would redeem at a financial institution to get your interest payment. But in addition to the coupon, you get paid your principal back. Now, some bonds, when you buy them at a lower price, at discount, than the what's called par value that they mature at. So for those kinds of bonds, when you buy them at a discount, you also get a form of return in the appreciation of the price from where you bought it and where it gets redeemed. And for some bonds, zero coupon bonds like treasury bills, short-term treasury bills are by definition zero coupon. They don't pay a coupon rate, but what they do is you buy them at a discount and you get full redemption of the bond when it matures at the full par value. But some other bonds, you'll actually buy it at a premium. So this screen, I did a filter to look at bonds that basically are about 2 years out. So this will allow me to look at some basic terminology of bonds. So here's the description of the bond. You can see it's the U.S. Treasury is issuing it. There's a maturity date, the date the bond matures and comes due. So in this case, it's July 31st of 2026. And then there's a coupon here. Okay, in this case, this bond pays a 4.375 coupon. So every 6 months, you're getting a 4.375% coupon. Now that percent is based upon what's called the par value of the bond. All bonds are issued at a par value of $1,000 per bond. That's the face value. They're priced, however, when you look at a price screen, you see here the price is 101. A long time ago, bond traders decided instead of talking in thousands, let's talk as a base of 100. So this price, 101.32, is essentially, move the decimal place over, $1,013.27 for one bond. You can see this is priced at a premium. It's above the issue price of $100,000 per bond. The reason that is, if you can see, this coupon is higher than this column. This column is what's called the yield to maturity. This is the market rate at any given point in time for what yields are on a bond of a certain issuer or credit rating and maturity. And so when we talk about yield curve, what yields are out at different lengths of bonds, this is what we talk about, the yield to maturity. Now you can see the coupon is higher than the yield to maturity. That's reflected in the price. Because you're paying more than par, this is going to mature at a par of 100. So there's going to be actually a little bit of loss purchase value of the bond that's being more than made up or being entirely made up by the fact that this coupon is higher than the prevailing market rate. Let's look at another example down here. This is the same maturity date, it's just a different bond. This one has a lower coupon, 1.875. So many investors naively think, oh, geez, that's a bad bond because look, that's got a lower coupon than this one. But what they don't realize is that this is trading at a discount below par. And it's this additional return you get in the fact that when this matures, you're going to get a full $1,000 or $100 per bond in pricing terminology, such that the yield to maturity is essentially exactly the same. The return for a bond comes from both the yield or coupon and or the price appreciation or depreciation, as the case might be. So this is a little simple graphic showing basically 4 different bonds of the same maturity. So there's a bond that has a 10% coupon interest rate, a 5% coupon rate, a 3% coupon rate, and a 0% coupon. Each of these zigzag lines are meant to reflect a periodic interest payment that you receive every 6 months if this were a treasury bond. You can see the 10% coupon rate, the size of these little zigzags are essentially double the 5% coupon rate. Well, this is at par. This bond is a newly issued bond, let's say. Because it's at par, these all have the same yield to maturity. Now, how can a bond with a 10% coupon rate have the same yield to maturity as one with a 5? Well, because you're paying a high premium price that over time is going to slowly erode down in value such that at maturity, you're getting the same par value. In this case, you have a lower coupon rate. How can a 3% coupon rate have the same yield to maturity as a 5% coupon rate? Well, because of the fact you're buying it at a discount, and that price is going to appreciate as it approaches the maturity date. And even a 0 coupon bond that doesn't pay interest periodically, because you're buying it at such a discount, the full effective yield is achieved by the price appreciation of the bond. So all these bonds have the same yield to maturity. And that's a big misconception by a lot of investors who simply buy bonds based upon the coupon rate. That would be helpful to look at an example investment, bond investment. It's an ETF. And please understand that this is not an endorsement of this ETF. So I'm going to share a page, ticker symbol AGG, which is the iShares Core U.S. Aggregate Bond ETF. This tracks the aggregate bond index, which is probably one of the most widely followed broad-based bond indices. So I want to show you this particular ETF. I'm going to show you how it's the different types of bonds that are in here. For example, sector. You see treasuries, industrials. So this speaks to the different kinds of issuers. You've got the U.S. Treasury, you've got companies here, you've got foreign governments, things like that. The next thing is maturity. You can see this has maturities of different durations. And generally speaking, in a quote-unquote normal bond market, longer maturities come with longer interest rates, with the simple logic being that if you're going to tie your money up for a longer period of time, you should be compensated with a higher interest rate. Now, that's a normal market. For many periods of economic history, we have what's called an inverted yield curve. And then there's credit quality. I talked about when you're buying a bond, you're lending, and you want to know about the creditworthiness of the lender. Well, there are rating agencies that have, for example, Standard & Poor's, Fitch, Moody's are all rating agencies. And there's basically a scale of ratings, AAA being the most creditworthy, right down through D, which are companies that are in default. Most governments have very high AAA or very close to that credit rating because they can tax and essentially always make good on their bills. They can print money for that matter. Whereas companies corporate bonds are more subject to the solvency and the creditworthiness of the company. Investment graded bonds, investment grade are, in this case, these are S&P ratings. Anything from AAA down to BBB is considered investment grade. As soon as you get below BBB, it's It's what would be called speculative or junk bonds. These are companies that are less creditworthy. So double B is the highest quality speculative grade. Then there's triple C and then C and D, for example. So that's something very important to consider. So speaking about the credit quality, when you're lending to a less creditworthy party, you should, and the market does indeed, reward you with a higher interest rate for the risk that you're taking on. So I have a screen here I want to share that looks at the yields at this particular moment in time, yields for different kinds of bonds. So here's a 10-year Treasury bond issued by the US government, and then various rungs of credit quality for corporate bonds, high grade corporate bonds right down to very speculative triple C grade. And you can see as of September 19, 2024, here's the spread of interest rates. So Treasury bond is 3.7%, whereas the market's compensating you for the risk in these speculative bonds at 12.27%, quite a bit of a jump in interest rates. But of course, there is no free lunch. The reason being is that you're getting a collection of bonds here, many of which could go bankrupt, and you could lose many pennies on the dollar, so to speak, on those investments. One thing I want to call out in this chart, though, is you can see during times of stress. So let's, for example, look at the housing bust in 0809. You can see the yields on treasuries went down because people flocked to them as safety. But notice this, the more speculative segments of the market, the yields shot up. At the same time, yields on treasuries were going down. The reason for that is investors were panicking about the creditworthiness, and rightly so, of many of the corporate bonds out there, especially, for example, the banking bonds, which we know many banks had to get bailed out during the housing crisis here, and the treasuries went down. These spreads, so to speak, are going to fluctuate based upon the different climates of the economic cycle. During times of recession or stress, the spreads will blow out, they'll widen because there's perceived and actually real increase in risk. So let's talk about the interplay between the price of bonds, the value of bonds, and interest rates. One of the biggest risks for bond investors, especially as you get out in longer term bonds, is what happens to market interest rates. I'm not talking about the interest rates, short-term interest rates that the Federal Reserve sets at their periodic monthly or meetings. Talking about longer-term interest rates that the market sets, essentially. And I've got a simple slide here to show what the relationship is. So it's a very helpful analogy to think about a seesaw. Basically, as interest rates rise, bond prices will generally fall. It's quite that simple. And as interest rates decline, bond prices or bond values will go up. So for example, in 2022, many bonds lost a bunch of value. Why is that? It's because interest rates went up. Inverse correlation there. So you want to be careful about that. Now, so long as you hold a bond to maturity, no big deal, because you're going to be guaranteed, so long as the issuer remains solvent, you're going to be guaranteed that you get your par value back, but also the coupon payments along the way. And that's the yield that you invested in when you bought the bonds. However, if you're forced to sell the bond prior to maturity at a time where interest rates have risen, you could very well suffer a loss on that bond. So that's one thing that many bond investors don't realize. The values can fluctuate quite dramatically given interest rate moves. And the longer the bond, the more sensitive to interest rates generally. The seesaw is moving more widely for 30-year bonds than it is for 10 years. So that's a very helpful analogy. This is a portfolio characteristics page for that particular bond ETF. Again, this is not a recommendation for this bond ETF. This particular investment has nearly 12,000 holdings, 12,000 different bonds. You know, one of the most diversified bond investments out there. You can see there's a yield. This gets to the coupon payments, the interest payments that get paid on these bonds that are passed through to investors. You can see the weighted average coupon is 3.4%. So there's a yield that comes both through coupon payments, but also the price action and the accretion of higher prices as the bond approaches maturity. So you can see that average maturity of this portfolio bonds is 8.25 years. Right here, you can see there's this thing called duration. Now, this is a very important term to understand. Duration is always going to be less than or equal to the maturity. So duration it's a measure of what's the average number of years for an investment in a bond for you to essentially get your money back. Duration is a function of a couple things. And the reason I'm talking about this is because duration is one of the key factors in determining how sensitive a bond will be to moves in interest rates. I just showed you that seesaw example of bonds and interest rates. Now, duration is going to influence how sensitive to those interest rates bonds are. So here you have a bond. At the end of the bond, you get your principal back that you lent to the issuer. But along the way, in this case, you have coupon payments, and it's shown by a stack of, I don't know, what's that, 5 coins. So each periodic coupon payment, you get 5 coins. Now, by definition, because there's some of your return that comes during the life of the bond, your duration is going to be less than the maturity. This is the maturity length of the bond out here. Let's say that was 5 years. Well, let's say this is maybe 3.5 years because of these coupons. The duration is less than the maturity. For a shorter term bond, this one has maturity, same coupon, but shorter maturity. It likewise is going to have a shorter duration. So duration can never be longer than the maturity. Now let's look at this one here. This is the same maturity as this first bond, but you can see the coupon is quite a bit larger. Instead of 5 coins, you got something like, I don't know, 12 coins here or something like that. Now, because more of the return of the bond as compared to this one is achieved through these coupon payments, it's going to have a lower duration than this one. So you can see the duration is further back along the spectrum than the top bond. Why is this important? All else being equal, a bond with a lower duration is going to be less sensitive to interest rate moves. Simple rule, it's not exactly linear, but to get a sense for the sensitivity of a bond investment to interest rates, I'm going to go back to that example. And a simple guideline, it's not perfect, but a simple guideline is for any given percent change in interest rates, you take that change and multiply it by the duration. It's going to give you an estimate of the amount of the capital appreciation or depreciation of that bond investment for that given level of interest rates. So for example, let's keep it simple. Let's say a bond has a duration of 10, okay? And there's a 1% increase in interest rates for bonds of that maturity, the market interest rate. Well, 10, duration of 10 times 1 means that bond will lose about 10% of its value because again, they move inversely. Conversely, if interest rates dropped by 1%, that bond should increase by 10%. Again, take the duration, multiply by the percent change in interest rates. So of course, a lower duration is going to mean those fluctuations, both up and down, are going to be less sensitive to interest rate moves. Now let's talk about some practical applications for how bonds can be used in a portfolio. Now there are, of course, many pooled vehicles out there, ETFs and mutual funds, for example, like the ETF I just showed. And they're a fine way to invest in bonds for long-term kind of stability and diversifications that bonds can offer a balanced portfolio against stocks, for example. And there's some logic to say that over long periods of time, you know, the younger you are, the less you should have in bonds and the more you should have in stocks, simply because over long periods of time, stocks have soundly outperformed bonds. Now, when you zoom into very short periods of the market cycle, certainly our style of management here at New Harbor is that stock and bond markets go through very cyclical, short-term bear and bull markets. And it's not quite as simple as setting and forgetting a passive pie chart. So you can also invest in individual bonds. Where that is very important or can be very helpful is in folks who want to have really tight control over when they have access to their funds. This is going to be for perhaps college education, perhaps for purchasing home improvements, whatever the case. And the concept here is what's called the bond ladder. So this is a very simple bond ladder with 3 rungs. So imagine here we are in 2023 and someone had $30,000 that they knew they were going to have to expend over some period of time, you know, for known expenses. Let's call it college education. There's 3 years left of a kid's college education. So one of the ways to do that is to ladder a bond, have a bond that matures here, then one that matures in 2024, then one that matures in 2025. And in this case, the college education example is not great because this is what's called the bond ladder that rolls. So the idea here is one way to hedge movements in interest rates is to have a bond ladder where you have some that are shorter term bonds and some that are longer term bonds. And when each bond matures, so for example, this one matured in 2023, the idea is you roll it out to the end of the bond ladder. So with each passing year, the shorter term bond matures and you roll it out to the end of the bond ladder. You can have bond ladders as short as, you know, a couple of years to 20 plus years, depending on the specific objectives. So this is a great way for someone that has known expenses coming up to ladder bonds of various types that can meet those needs with certainty. You don't have to worry about the stock market risk. And so long as you can hold those bonds to maturity, you know that principal is going to be there. And of course, that the issuer of the bond stays creditworthy and can make good on their promises to you. There are many different kinds of bonds that I'm not going to have time to touch here today, but one of the biggest risks in bond investing, because it is a fixed income, is the risk of inflation. Cost of living can go up, and we know that periods of time, inflation can be quite heightened. We've just witnessed that in the last couple of years here, as I look back from this date in September of 2024. And there are ways to mitigate that. For example, in inflation-protected bonds. The U.S. Treasury, for example, has what are called Treasury inflation-protected securities. These bonds do pay a coupon, but they're unique in the sense that the principal value Whereas regular, what are called nominal treasuries, the things I just talked about, the principal value is static. It's going to fluctuate with interest rates. But with Treasury inflation protected securities, the U.S. Treasury is going to adjust the principal value up or down depending upon the actual rate of inflation as measured by CPI. That's the metric that is used. So if we had a scenario where inflation went really high for many years, and a fixed income normal treasury bond, you're getting this guaranteed income, but that income's losing purchasing power because the cost of things have gone way up. Well, an antidote to that is to buy Treasury inflation protected securities. So this is off of Bloomberg's website, and I want to look at 5-year bonds. So here's a 5-year nominal Treasury, and you can see the yield to maturity in this case is 3.52%. We can look at a Treasury inflation protected security of the same maturity, 5 years, and we can see the yield is 1.47%. So 3.52 versus 1.47 is like 2.05 difference. That difference is what we call the break-even yield. It's essentially the yield that is the market's estimate of what inflation will be over that 5-year period. And simply put, if inflation runs higher than that 2.05% over that 5-year period, you're going to be better off having that inflation protected bond because you're going to get compensated for that higher inflation through an upward mechanism adjustment of the principal of that bond. So it can be a very important tool in a bond portfolio that is otherwise potentially at risk for inflation and erosion of your purchasing power. As I said, there are many other types of bonds. I'll just quickly mention municipal bonds. One of the key features of municipal bonds is that they are tax-free. And in some jurisdictions, they can be double or triple tax-free, meaning most bond interest payments, for example, on corporate bonds, is going to be subject to income tax. So the coupons you get is added to your taxable income, just like interest on a bank CD or whatever. Municipal bonds, however, are tax-exempt. They're free from federal taxes and also local and state taxes. Because of that, they trade at lower yields. But that lower yield, when adjusted for taxes, for some people, especially those in very high income brackets, on a tax equivalent basis, may be, in fact, a much better, or at least a marginally better yield. So that's something to think about. Again, there are many things that I won't be able to touch here, but I hope this was a useful video to help you in some of the more nuanced aspects that don't oftentimes get talked about in the bond market. Of course, we welcome your questions here at New Harbor, both our clients and any folks that might have come across this video and just simply want to have a friendly conversation. We're all about education, and I hope this video was helpful in doing that. So again, this is the first installment of a series on investing for income. This was about bonds. The next installment is going to be about dividend and other types of stock income investing approaches. So thank you for watching, and until next time, have a great day.